All right, today it is St. Patrick's Day, and we are super lucky to have Casey Stenzel and Peter Buck share with us the mysteries of the M&A process. This is the second in a series of masterclasses that TAG is sponsoring to share more about the pitfalls of mergers and acquisitions and how to avoid those. So we're going to be doing these monthly. They'll be available on demand later on in case you want to refer back to any of the brilliance you'll hear. So our Wednesday wisdom today is coming from Casey, who's the Chief Financial Officer of TA Group, and Peter Buck, who is the CEO of TAG Ventures and our General Counsel. They've seen a lot between the two of them, and they're not going to be shy about sharing the good, the bad, and the ugly. So with that, I'll let you take it away, guys. Thanks.
Right. Just to set the stage, folks, this is about wanting to start a process to either buy or sell a company. We're also focusing primarily in private equity, not publicly traded deals, but just more bread and butter investments and sales with regard to privately held companies. So the focus is going to be on what are the steps you go through to achieve that outcome, a sale or a purchase. And we'll probably lean a little closer to the sales side as we've been through that a few times, and it's a little easier to digest. So starting off, we talked about strategic buyers and financial buyers in the last M&A Pitfalls webinar. And I'll just paraphrase or just go back into that a little bit. Strategic is generally a buyer who has a unique need to pay for the service or product that usually results in the highest amount of payout to the seller because there's something unique that adds to their stack of products or portfolio, and they're willing to pay a higher multiple. With the juxtaposed strategic with financial, where it's more based, a financial sale is based more on future performance. So typically that would be professional services, staffing, things that companies that rely on future cash flows in general. So you need to kind of decide as a company, are we going down a path, a strategic path or a financial path? It's super important to differentiate because it really dictates the universe of potential buyers that we're addressing. So the big first question comes up is if it's a big enough deal, and Peter and I have done deals on our own without any investment bankers, but we have 2 or 3 times now hired a investment banker to represent us and help us. And a lot of times that's a very strategic decision in itself, as if you have an investment banker who really knows a particular industry, knows the players in the industry, you will have a better list of buyers that are going to be more focused on what we're trying to achieve as well. So the first kind of big deal point in this webinar is, how do you go about selecting an investment banker that can work for you? And it's pretty straightforward, but I think our record is we interviewed something along the lines of 30 investment bankers several years ago for one of our companies, narrowed it down, eventually did not complete the deal, but we learned a lot through the process. So we just created criteria like, let's go have a call with a firm or an individual who can represent us. And you look at things like, what's the size of the firm and location? Are they a generalist? Are they a niche player? They really have a specific background in a certain industry. What is their specific relevant, experience in actually achieving good results for their customers? Who would be our main point of contact? That's a huge one because they really are the quarterback assisting us. And then just money, fee structure. Is there a retainer involved? Do we cover expenses? Is there a success fee? Is that success fee based on a percentage or reaching a certain plateau or milestone in terms of deal size? And then ultimately, it comes down to what is our confidence in that banker and our firm, and can they do the job we need them to do? And then there's another little aspect that we always ask about, which is we ask the banker, what kind of auction or bid process would you use? Would it be highly targeted to specific buyers in a specific industry? Would it be a customized reach out to companies we don't know, but we think they would be a potential buyer? It can be a very broad process or very deep and robust process, or a mix, a hybrid of them all. So that's the first step in the process, is to get your representation in order. And then the next step is let's go.
Hey,
Yep.
Case, I'm
Yep.
going to dive in just for a second. Just a couple points to add some color. Growing up, my dad always told me that investment bankers were good for one thing, and that's getting golf tee times. I think they're more important than that now that we've gone through this process a number of times. But I think, as Casey says, fit and experience are super important. When we did a deal on the sell side back in 2017, we did it in 25 days, and we probably spent 15 hours a day with our investment banker. So you better like that person. That's one. And then two, can they get you the meetings and in front of the right folks to get your deal done? I think that's the key question you have to ask. And they all say they can do it, but you've got to dig pretty deep to make sure that they actually have those connections to get you in front of the folks.
And to add on to that, they also can do the back channel conversations with the buyer that take us out of the equation, so they can have a little more blunt and open conversation and kind of finagle on our back, on our behalf, and just kind of help grease the skid, so to speak.
Yeah, because they're not the ones negotiating the deal. Typically, that's the internal folks at your company. But as Case says, they are in the background, and they're able to sort of move the needle on key deal points without putting their client, us, sort of in the line of fire, which is a nice feature.
Yep. So once we've gone to that point, we are now going to start the confidential information memorandum, or the SIM, which is kind of the backbone of almost every deal we look at. And that's something that's usually relatively brief, 10 to 30 slides. PowerPoint is probably used the most often. But basically, it's just a put some chum in the water and see what bites kind of process. And that gives us a sense fairly quickly of what's the interest level here. And then once we formally decide what kind of process for the actual bidding war we hope we create, picking that and sticking with it, which then often includes doing things like road shows, where we will go and, whether it's on Zoom or a phone call, have a 60 to 90 minute meeting with as many interested buyers as possible. And that will also give us a lot more guidance. And if you think about it, it's a funnel type of process. You maybe start with 100 targeted buyers, and just through higher and higher levels of exploration into our business, folks will drop out, either because they don't think it's a strategic fit, or it's not what they're looking for. But ultimately, it all funnels down at the end of the day. Anything to add there, Pete?
Yeah, a couple things. Talking about creating your team on the sell side. Keep it small initially. It's hard to keep secrets, and you want to keep the secret as long as you can. So keep it as small as you can for this first period. I think, as you go through it and you narrow, as Casey said, you narrow the funnel down, folks are going to want to start talking to the company itself and to the people in the company, right? Because if you take, Casey and I aren't going with the deal, but the people in the company might be going with the deal. And so they need to start to get to know those folks on an as needed basis. The other thing is that by this point, diligence has started to some degree, and you may start populating your virtual data room. And it'll be interesting. It's typically interesting to go in there as you're going through this process and you've got groups in there. You can tell who's interested and not, right? If you've got a robust enough tool, you can run reports on who's been in there. And I recall many times running into Casey's office and say, hey, Case, did you know so-and-so has been in there all day? Whereas some other group that we thought maybe was the front runner wasn't in there at all. Now, it's not necessarily mean that they're the most interested, but it's definitely a sign.
Yeah, great point. You can't get that type of feedback if you're just using like a Dropbox, which is very static. But if you go ahead and pay the much higher amount to have a much more robust data room, you really do get to see exactly the audit trails and tracks that folks are making. So getting back to our little funnel process, we typically want to get to be 5 and 10 serious contenders. They've expressed interest, they like what they're hearing. Those will usually result in non-COVID times a meeting in person. In the last deal we did, we had, I think it was about 8 firms come over a 2-day period in our headquarters down in the Sacramento area. And we got, I think it was 2 to 3 hours with each firm to really get down deeper and to have at least 1 or 2 of the key employees who might be going with the deal involved and in the process. And that is super helpful because what we're really trying to get at is our top 3, the 3 most viable, interested folks. One of the ways we get there is we start with an IOI, an indication of interest. So this is a 2 to 3 to 4 page, almost questionnaire that the bankers will provide, which basically looks to what do you think the value of this thing is, and kind of the high level points and feedback we want to hear and see, and that just gives us another way to really explore who is our potential buyer. But at the end of the day, we want our top 3. Anything to add there, Pete?
Oh, I just think, one of the great benefits that the banker provides at this point is creating deal tension. So as we go through this process and as the funnel gets narrower, they're talking to the ones they think are the front runners and saying, hey, so-and-so's in here too. And they may not name them by names, but one of their jobs and one of the key benefits at this point is to create that tension so that folks stay engaged and think hard about making an offer that's significant.
Yeah, very relevant when we did our deal, a different deal that was a 10-month process back in 2017, where we kind of knew who the front runner was from the get-go because they'd made 2 or 3 runs at us over the years. So that deal tension aspect massively helped us to get that premium that we didn't even think we would get. So that deal tension stuff is definitely a huge factor. So moving on, in addition to doing the IOI, we get down to the final 3, and this is how we've done it in the past, where it's a day-long meeting, and we really roll up our sleeves. More of the buyers folks will come in and really scrutinize us. It's like going through an audit, and at times it even got heated. But it really gives both sides a chance to see who are these people and can we work with them and will it work? And then we always end the day going to a group dinner and then just kind of letting our hair down and really getting to know folks better. And that part's just downright fun. And once everyone's kind of relaxed and in that environment, you probably learn even more. So that's the process we've done a few times now. So the net result of this process in part 1 is, we have because of what we've done up to date, we have a much better understanding of, where we sit in terms of valuation, key leaders, key deal points, the stuff that are super strategic to us and them. Pete, any more on that?
No, I think that's exactly right. Once we get to that point, we've got to, we want a winner, right? We want a best and final, and we want a winner. And once we get there, we're at the LOI stage, right, Case?
Yep.
And our preference on an LOI is to go fast and keep it light. You can spend days or weeks negotiating an LOI. And our preferred method of doing it is to keep it easy, keep it light, and spend our negotiating cycles in the definitive agreements. Typically, the only binding piece of an LOI is what's called a standstill, which is where it's basically like a no shop. Once we sign the LOI, if we're the seller, we can't start talking to other people for some period of time. And you can understand why the buyer would want that. They don't want to spend all this time and then have it get sold out from underneath them to somebody else. But other than that, everything, even though there's a framework of a deal, everything is still non-binding and negotiable. And our preference, Case, and you can give color here too, is to spend our cycles in the definitive agreements rather than in the LOI.
Yeah. Yeah. I mean, there's really two phases or two steps to these deals. And up to now, we've been doing everything we need to do to get that process running and working. Sorry, my Teams is calling me. That's super annoying. Anyway, this process culminates in for those of you that have done any government contracting, a BAFO, a BAFO, a best and final offer. And that's really what we're asking the final three prospective buyers to provide to us. And this can be done, usually it's done in a kind of closed process. So the final three don't know what each other have submitted, but it gives us the opportunity to sit back and evaluate not only the price, but the deal structure, the timing of payments, key considerations, assets that may not come with the deal. All of that is predicated on all this work we've done to date. And from that, we then pick our number one. And then we usually, the banker also helps with this. They will provide the debriefs to the two other finalists that didn't make it. And that really gets us to kind of the end of phase one, which is getting to a point where we have an LOI, so a letter of intent that gives exclusivity to the buyer, and it could be for 3 months, 4 months, 5 months, 6 months, et cetera. And really, it's your end. I mean, if I use marriage as an example, you've just gotten engaged. You've proposed. They've got a ring, but the wedding hasn't happened yet. And at that point, I'm going to start passing that off to Peter to talk about kind of the phase two process.
Tell me this is wedding planning time, Case? Is that what you're saying?
It's almost spring.
Okay, got it. So now you've got an LOI and you've got the framework for a deal. Now what? And typically what we see is there's a dual path at this point. The diligence continues. More people get involved. They may bring in their HR folks. They may bring in their tax folks. They may bring in their benefits folks. Everybody comes in and starts taking a look at their respective areas of expertise. And we'll typically want to do, interviews with their counterparts in the target company. At the same time, you're drafting definitive agreements, the purchase agreement, and all of the side documents that go along with that. As you go through this process, one of the big things that we face every time is, okay, what kind of deal are we doing here? Are we doing an asset deal? Or are we doing a stock deal? And there are some key differences. Stock deal, you buy everything. You buy the equity, you buy the assets, the liabilities. It's an all-in-one deal. Typically simpler, and you can go faster, but also fraught with peril because you don't know what you don't know. And sometimes you can step into a liability that you didn't foresee. Why would you do an asset deal if the other way, if a stock deal is simpler? Well, it depends what you want. Do you want the whole company or do you just want a piece of it, right? Maybe there's a division that you don't want that has nothing to do with your strategic plan, has nothing to do with your business, You don't want it. So you say, look, we just want to take certain assets and we want to take certain employees. Maybe they've got a messy shareholder situation, a messy capitalization table that you just don't want to deal with. And that happens a lot. Maybe there's a known liability that you don't want. Maybe they're in litigation. Maybe they've got a massive debt, loan out there that they don't necessarily want to pay off or can't pay off right now. And you say, fine, you guys keep that. We're going to take the rest of these assets and we're going to go. There are a couple of more steps in an asset deal that you wouldn't have in a stock deal. You essentially have to terminate all of the employees of the acquired company and rehire them as your employees. It's not a big deal. It's just another step. It's an integration piece, and it's something that HR has to get involved in. Can take time. You get to kind of pick and choose which contracts you want. And in many instances, you're going to have to get those assigned from whomever the other party is. So let's say, for example, the company you're acquiring has a great deal with Google, and you want to continue providing services to Google through that contract. Well, you're not a party to that. So you've got to go out to Google and say, hey, we just bought so-and-so over here. We'd like to assign this agreement so we can continue providing services to you. Typically, it's not a big deal, but it takes time. Case, do you want to talk a little bit about basis and goodwill in the difference between the two?
Yeah. So there's real tax advantages and disadvantages to doing an asset deal versus stock deal. I would say high level, an asset deal is better for the buyer because they're able to take both the value of the deal. So say it's a $10 million deal. Basically, any future sale of that same group of assets wouldn't be taxed for that first 10 million. It would be any value that was created after the deal. So that's one huge advantage. The other one is if you do an asset deal, any goodwill on your books, which is an intangible asset, can be amortized over 15 years. So it's another way for owners in a company to get tax breaks, basically. And with a stock deal, neither of those things are allowed. You don't get basis, meaning if you buy a company for $10 million, the clock starts at zero. So if you go sell the company for 20 million after that, you're paying tax on all 20 million. So that's a big consideration when you go to do a deal, and you need to be very clear with the buyer, even way up front, that in the case of the company we sold in 2017, it was a division of a bigger company, and so it just made sense to carve it out and do what Peter said. They all resigned and became employees of the buyer, et cetera. And then I would just add, at this point, this is kind of where deal killers happen. Because let's just say, well, I'll just list some things. So what's killed deals for us is the company just has too much debt, and we can't really help them with that. And that would be a reason to reconsider or walk away. Litigation, pending or in action. If it's significant, you don't want to do a deal with a pending litigation situation. We have done that once, and it was a little scary at times, but we got through it. Owners not on the same page. This happens more than you would ever believe. One really wants to sell, and one is just hemming and hawing or really doesn't. And in scenarios we have a 50-50 ownership process, and you don't have a LLC agreement or some kind of operating agreement that says how to choose on whether or not you go forward or not. You see these examples all the time of just two owners who are completely deadlocked and can't agree amongst themselves, and we can't do a deal on that. It becomes really, really messy. And then one other one, we had a really great deal teed up about 2 years ago, and the major customer was Apple. And we went down the path. We were close to signing a deal. We found out that Apple forbade it. They just said, nope, we don't want anyone else. We want you. We will not assign our contract to the buyer. And that stopped the deal immediately.
And that shareholder issue cannot be overstated. I mean, even if you can figure out a way to jam it through on the transaction, they're still there. and they're still having issues and they're still having problems agreeing. And you know that down the road, something else is going to happen and you're going to be deadlocked again. And it is one of our sort of key tenets that if that's in play, we don't do the deal, because it's just, I've lost all this already. I'll lose the rest over those kinds of transactions. It's a non-starter. So as we go on and we're drafting the definitive agreements, many times we'll engage outside counsel. Many times we'll engage a tax advisor or accounting firm, depending on what we need. We try to do as many of them as we can by ourselves, but there are sometimes we don't have the bandwidth, or it's larger than we think, and we need help. But the timing of it really depends on size, and it depends on willingness of both parties to go fast or to go slow. And our approach is always to go fast, because time kills deals. But sometimes you can't necessarily control the other side, and so you've got to find a pace that works for both sides. As you go through the process, there are gotchas, right? And we've seen them over and over again. We've looked at companies where we've gone into diligence, and the executives have these massive golden parachutes that says if a transaction occurs, they get paid and number hundred thousands of dollars. That's a big problem. You've got to factor that into the deal price of the deal. We've seen issues with intellectual property. We did a deal a couple of years ago where we bought a company that was licensing all of its technology. And at the time, we're like, that's fine. Doesn't matter. This thing's going like this. It's going to the moon. Well, it turns out it didn't go to the moon. And trying to repurpose that technology for other purposes is very difficult when you have a third party that owns all the rights. So those kinds of things can jump up and bite you. Case, do you want to talk a little bit about net working capital? I know that's something that we've fought tooth and nail in every deal we've done on either side, and it's something I think that's super important.
Yeah, there's a few key sticking points that we encounter in every deal. And the first one we alluded to a little bit, but just getting the 1 or 2 or 3 key employees to go with the deal. I mean, they may love where they work and don't want to go to this big giant corporation in the Midwest. And so, and helping them negotiate their employment agreement is something we do. Pete can talk about intellectual property issues and just how corporate lawyers in general, and then the assignments. But in terms of net working capital agreement, it's actually one of the most emotionally charged aspects of doing a deal, which is kind of silly, because the whole point of it is both sides want to be fair to each other, in that the buyer wants to know, we need some startup capital here of yours. I mean, if you have pending payments and accounts receivable, or you have a big cash balance, we want you to give us, 3-month runway for when we bring on this new company we just bought, and we at least want to cover payroll or some financial metric that's a net positive. So net working capital obviously is basically short-term assets minus short-term liabilities. So we're talking about primarily cash and AR and AP. And then to a certain extent, sometimes payroll's in there as well, sometimes not. It really comes down to what the buyer and seller are willing to negotiate and agree upon. But the metrics are different every single time. And it's kind of fun in a way, because it can be super creative, and you can have all kinds of different outcomes. But the deal is that usually the buyer gets some protection and relief on the initial, close of the deal when we bring on new employees, et cetera. So they don't want to be out of pocket right off the bat. That's kind of the gist of the net working capital agreement.
Got it. Yeah, a couple other things you need to think about. Like I said, the IP can be a gotcha, depending on what kind of company you're buying. Assignments. So as you hurtle down the tracks toward getting a deal done, many times there are things you want to see from the company you're buying, or the company buying you wants to see from you before they'll close the deal. So let's talk a little bit about the mechanics. So a lot of times what'll happen is you'll negotiate all the documents, they're all done, and you'll say, okay, we're going to sign on date X. We're going to sign on April 15th. But we're not going to close until sometime in the future because the seller has to do this list of things in order to satisfy the buyer that it's a good deal. So they're called conditions to close, and they're very common. We put them in all our deals. We had to do them in the deals where we've sold. But they're things like, there are 5 key contracts for the company you're buying. And if we don't get those, if we can't get those assigned over, we're not going to do the deal. And so you say, okay, fine, we're going to sign the deal, but then you've got 45 days to go get these assigned. And once you get all of them assigned, that condition is checked and we can keep going down the list. We want the employees. So we've put terms in deals before where we say, look, if we don't get 80% of the employees to sign employment, offer letters with the buyer, deal's off. So you have a big list of conditions that the seller must reach in order to go from signing of an agreement to closing of an agreement. What does closing mean? Closing means cash or whatever the consideration is at the end of the deal. But sometimes deals crater in that interim period because they literally cannot make the conditions. We've seen financial covenants in there where they have to have either a certain net working capital number, or maybe it's right at the end of a quarter and we say, hey, you've got to hit X in revenue and Y in net income for whatever quarter we're just about to close, or we're not going to do it. So that those are risk mitigation techniques that buyers use to make sure that they're getting what they think they're getting. Anything to add on that one, Case?
No, exactly right. I think the other thing we talked about is just kind of IP in general and how that can be uniquely tricky.
Yeah, for sure. I mean, it depends on the kind of company you have, but you want to make sure that you've got rights to any IP you need. And there's a couple of different ways to make sure you get it. One, do you have solid employment, confidentiality agreements with all your employees that assign all of the IP they create to the company? That's one. If you don't have that, you don't know what you have. And 2, have they documented either their trademarks, their copyrights, or their patents in a way that is sufficient to you to get a good feeling for, that they own what they say they own. Of course, you can get them to represent that they own these things, and to the extent they don't, you may be able to come back and make a claim later. But that's not where you want to be, right? That's an insurance policy that buyers have to ensure they get what they think they're going to get, but you don't want to be in that position. You want to know upfront that you're getting, the benefit of your bargain.
Yeah, the other aspect that's changed a little bit over the last just 2 years or so is kind of gets into a future webinar topic, which is an earn-out process or related. So how do you actually get paid? And there's so much meat around just doing an earn-out, which is based on some amount of cash upfront to the seller and then the commitment to stay on for a certain length of time and earn out the full value of the deal. But we'll reserve that for a whole nother webinar. But in general, there's a couple other things that come into play that have for us in the past. And that is, there's a term called reps and warranties, and that's part of the definitive agreement. And so each party is warranting certain aspects of the deal from their perspective. And in the past, we've had what we would call holdbacks or escrowed funds when we complete a deal. So let's say the example is in one of our deals in 2017, we received, I think it was 90% of the cash up front, and then had 5% held back for 1 year after the deal closed, and the other 5% paid the year after that. And that's really just historically been a check and balance for the buyer, so that, let's say, after they did the deal, 6 months down the line, a major IP issue comes up, or they get sued based on something we sold to them. They want to have the ability to claw back some of that unpaid cash. But what we've learned more recently is that trend has changed to the better, in that insurance companies, commercial insurance companies, are now offering a reps and warranty liability policy. So this allows the buyer to pay 100% of the deal up front and still feel protected if something comes up down the road. So that's a pretty new convention that I'm super excited about. You don't have to wait the 2 years or year to get the full payout. You get it right at close. That's a very new development that we only learned about recently. So that was fantastic.
Yeah, I mean, as a seller, that period after closing where you have most of your cash but not all of it is super nerve-wracking, because you've given up control of the entity you just sold, but you still have liability for some percentage of a purchase price, and it could be millions of dollars. And I recall clearly a case when year one ticked off and year two ticked off. It was a sigh of relief that there had been no claims and that they released those funds back to us. So it's an interesting process. I understand why buyers do it. It's basically they're creating insurance for themselves, but it can be nerve-wracking.
Yep. And then at the end of the day, we've completed step 2, phase 2, and then it's time to celebrate, and that's super fun too. So usually that's a dinner with the bank, all the bankers that provided support, lawyers, accountants, and it's a great way to celebrate. That's when you get your tombstones later on showing you did a deal and the lucite, neat stuff. And you're off to the races. So I think at this point, we are open for Q&A.
Thanks, Casey and Pete. So I have everybody able to talk. You can submit questions and I'll read the ones that have already been submitted, or you can unmute yourself and ask once we're finished with these. So the first question from Justin is, Casey, you mentioned confidence in your banker being the most important item. So outside of niche and experience, how do you establish that confidence in the interview process?
Yeah, because we spend the time to go first create the criteria that are most important to us, we actually spend time with them. And it's pretty shocking, to be honest with you. Sometimes let's say a LA-based boutique firm that has 13 people and they put one of the more junior folks up front, and that probably wasn't going to work for us. Just hearing their experience, and sometimes they're solo practitioners that have deep experience, but will only commit to working on one customer at a time because that's just how they run their life, and they might not be available. So there's so many aspects we have to ferret out to get to the right person. In the case of the company we sold in 2017 that was in the public safety arena, we had a hard time finding someone that actually had deep experience, a banker with deep experience in that particular industry, and we found him in Minneapolis, and it ended up being a fantastic relationship. And then in the other case that I know Justin's aware of, Will, who was just an individual, just blew us away in person when we got to interview him, and had deep experience with a boutique firm, had been in the industry that we were in, but just was so dialed and smart, and it exudes so much confidence that we pretty much hired him on the spot, and he was fantastic for us and quite affordable on top of that. So Pete, do you have anything to add on that one?
No, I think that's exactly right. I mean, it's a fit thing. Can you work with this person? It's not much different than interviewing someone for a job in your company. Does this person have the qualifications? A, okay, yes, most of them do. But 2, Can you work with them? Are you ready to spend 15 hours a day locked up in an office with them for a month? I didn't know that at the time, but it matters. And yeah, I think you're right, Case.
Yeah.
Thanks. Question number 2 is, how does the CIM structure differ based on strategic or financial buy? If it does differ, how and what information is most relevant to each?
Yeah, I don't think it differs, whether it's a strategic or financial buy. I would just simply hope that on a strategic CIM that they would be really heavily touting why it's so strategic and what IP they have and what key folks they have and things like that. Whereas in a financial buy, you're going to be probably more numbers focused and transactional in nature. But I don't know that they're all that different.
Well, and remember, investment bankers want to get deals done. And so they're going to draft the CIM to appeal to as broad an audience as possible, because we can define whether we want a strategic sale or a financial sale, but many times you see both. And they tend to sort of ferret themselves out through the funneling process. But the investment banker's incentive is to sell the company. So they want it to appeal to a lot of people.
And there's just the basic facts. I'm drawing a bright line, but generally speaking, a strategic offering is going to be product based and or recurring revenue based. Those are typically considered strategic and how they fit into the acquirer, and whereas financial buy is almost always professional services of some kind. So very transactional and may have some strategic relationships and aspects, but for the most part, you're buying on the come in terms of future cash flows.
Next question comes to us from Taylor. How does the introduction of the reps and warranty policy impact pricing?
I think the short answer is we don't know yet because we haven't seen it in a deal, but my guess is that it will, the buyer typically pays for it. And so they're going to adjust the purchase price based on whatever that premium is for the rep and warranty insurance for, the tail period, 1, 2, 3 years.
Yep.
Okay, another one from Taylor. What selling cost should sellers expect or be aware of outside of capital gains?
Well, there's transaction costs, right? You've got outside counsel, you've got tax folks, you may have accounting folks. There may be some, technology costs to the extent you're doing a data room. There may be regulatory filings depending on how big of a deal you're talking about. If you're talking about a public deal, there's regulatory filings. There's, Hart-Scott-Rodino and things like that. It depends on size, but those are some of the big ones that are deal costs versus personal costs.
Yeah, and after you pay for your tax accountants, your lawyer, data room, your travel, the banker has a success fee. Those are all just expensed. I believe. I don't believe you can capitalize all of that. But in terms of the owners of a private equity group, yes, capital gains would be enforced for them. However, in a more financial transactional deal, typically any cash and AR that you receive or sell would be closer to ordinary income. So it's really everything above asset values being sold is cap gains.
Great. We have one from Kevin. Do the different forms of businesses present unique challenges or benefits for the buyer? For example, buying an LLC versus an S Corp versus a B Corp.
I'll start this one and Peter can finish it. One of the weird aspects. LLCs and S corps are very, very similar with one unique difference, and that is in an LLC, you kind of anything goes with respect to the owners. They can distribute money, $1 to one person and $100 to another person in terms of the ownership team. With S corps, you are mandated by federal law to only receive your pro rata share of your ownership. So if you're 20% owner and there's an 80% owner, the 20% owner is only going to get 20% of the cash distributions. So that's kind of one of the main differences between LLC and S corp. And we generally run away from C corps, just to add that in. But Pete, do you want to add to that?
That's exactly right. We just we've looked at C corps before, and it's just from a tax perspective, it makes no sense to the buyer or frankly to the seller. I remember, Casey, that was last year, the year before, we looked at one and we calculated the taxes based on the purchase price, and it made no sense. So most of the deals we have done have been LLCs. That may just be fortuitous, or we've made some conscious decisions not to do C corps.
Yeah, that C corps truly are a good idea if you are pretty confident you're going to go public at some point. You're set up to hit the ground running. But if you don't, then you're just double taxing yourself. So.
Okay, we have another question from Justin for Peter. What do you find are the drawbacks of moving much of the definitive terms out of the LOI and into the final agreement? And how do you mitigate those drawbacks in the process?
Yeah, I guess my first answer is it depends who you are. If you're the buyer, you want to get into exclusivity as quickly as you can. And so making the LOI process short and sweet gets you there, because then all of a sudden you've cleared out all the rest of the buyers. If you're the seller, your objective may be a little bit different in that you want to make sure that once you go into exclusivity, they don't get squirrely, the buyer doesn't get squirrely on you and start changing the deal. So I think it depends. I think my initial comments about that, Justin, were really from a buyer's perspective, but I think it depends on who you are.
That's all of the submitted questions. Does anybody have any they want to just ask live? If so, you can just take yourself off mute, show your face.
This is Kate Rush. Hang on here. I was curious about, I think you mentioned employee retention and incenting, percentages of retention. Anything else you've seen that's particularly creative or noteworthy around employee retention, particularly through the ranks?
I think it's tricky, because the best way to get people excited about an acquisition is to tell them about it, but you can't do that too soon because you don't know if it's going to happen. And so there's this balance between information coming out early and waiting until the ink is dry on the deal. And I think the key is to have a very good integration plan once the deal is closed, with super tight communications to each of the groups that are important. And I sort of look at it as you sort of start in the middle and you radiate out, right? You start with the company, then you radiate out to the acquired company, and then you radiate out to the public. But getting in front of the acquired company's employees and letting them know what has happened, and letting them know that, because without information, everyone is going to say, I don't understand what's going on and what's going to happen to me. And that's the answer you have to be able to give them very soon, to say, hey, not an issue here. You guys all have jobs. We're bringing you over to company X. We're putting you on our payroll, and things are as is. That's the message you want to send. And the sooner you can do that, the better.
And then I would just add that the buyers typically will look pretty hard at the full list of employees in a division or in a company, just to kind of see, like, where do we have overlap? So let's say we don't need 2 IT managers or what have you. So they will oftentimes list who is available to go, and then the buyer can say yes, no, yes, no. The other aspect that we've been involved with is in the case in 2017, we keep referencing the public safety sell side process we did. The three key folks who really truly were absolutely key to the success of the deal didn't really want to go. And this company was based in the Midwest. And so between us and the buyer, we basically provided some very large cash payments for staying X amount of months or days or years, and just gave them extra incentives to stick with it, because without them, there's no deal.
Are there any other questions? Going once, going twice.
Sold.
Sold. All right. So thanks a lot, Pete and Casey, for all the wisdom. We're going to do this again next month. And Casey actually teed up this topic, but it's going to be about understanding earnouts. So you can see the bit.ly, it's bit.ly/pitfalls3. If you're going to be around on Earth Day, which we're going to reclaim as Earnout Day, I hope you'll join us and tell your friends. So Pete and Casey, any final words?
Nope, can't. I mean, I would just simply say, looking forward to the next one. It's going to be kind of diving into the psychology of the deal a little bit more, and there's always emotional reactions to any kind of sale and or earnout process. So there's a lot of meat for that discussion.
Yeah, no, looking forward to it. Thank you for all joining. It was great.
Thanks for all the great questions.
Yep, appreciate it.
Have a good day.
Thank you.
Bye.
Yeah.